As a part of my forensic accounting course, I was tasked with creating a fictitious fraud scheme that would later be investigated by another student. My fraud takes place in a country club with a manager, we'll call him Ryan, who feels he is underpaid and therefore feels the need to steal from the company. As a part of his role, Ryan manages the lounge, does payroll, makes schedules, and pays vendors. Because his duties include making receiving reports and paying vendors, he creates a fictitious vendor and creates fictitious receiving reports to back up the vendor and is able to pay himself an extra $500 every 2 weeks under the fictitious vendor's name. He has the rationalization to do this because he feels he should be paid this much anyway. He has some pressure and incentive to do this because he wants to retire soon. And he had the opportunity to do this because this country club is small and did not have proper segregation of duties or a proper reconciliation process. In this case, all three aspects of the fraud triangle are present. The fraud triangle is a framework that identifies the three components that increase the risk of fraud occurring: opportunity, pressure or incentives, and rationalization. In the fraud triangle, opportunity is the only component that companies can control. So how can companies reduce the opportunity of fraud occurring? Companies can implement strong internal controls, have regular audits and reviews, and separate the key functions of custody of assets, authorization, and reporting. Small organizations, like the one in my fictitious fraud case, oftentimes have a harder time implementing these, especially segregation of duty, but it is possible. In my fictitious fraud scheme, there are 3 managers. I would recommend one manager having control over purchasing, one manager having control over invoices and signing checks, and one manager having control of custody of the checks. The organization could also implement automated controls protecting against paying unauthorized vendors, and the owner could review invoices periodically. A thorough record should be kept, including records of cleared checks. Fictitious vendor frauds, like the one I just described, are usually dependent on 3 factors: the ability to add the fictitious vendor to the accounts payable vendor list, the ability to make the payment, and the ability to keep the payment posted to an account unnoticed. On top of the measures already discussed, some measures to intercept on these dependencies would be requiring vendors to provide a physical address, requiring verification of the existence of new vendors, and having a review of new vendors added. By implementing these preventative measures, a company can reduce the opportunity of fictitious vendor frauds like the one I created in my fictitious fraud scheme.